Hi, everybody. Welcome to our training. What we've done now is we have broken up the training into several compartments. You're going to notice that initially we had one big presentation, but now we're going to have multiple smaller ones. The first of them is going to be the actual presentation. Then you're going to see another video on how to get a commitment, get a dollar amount commitment. Then you're going to see another video on how to do what we call the box close. And then other videos, for example, how to recruit the sale, invite the sale, and how to overcome objections and things of that nature. We thought this would be a lot more effective this way. Now, your basic presentation shouldn't take more than about 10 to 15 minutes. Now, mine is going to take a lot longer because I'm going to stop and explain things, but you need to go over your presentation so many times that you are very fluid and very, it just rolls off your tongue very easily. If I ask you what your name is, what's your name? You're not going to go, I think I know this. Wait, no, you're going to go, my name is John. My name is Mary. Okay, that's how well you need to know your presentation. Also, the other thing about presentations is that you need to know a lot more presentation, a wider array of things in your presentation than you're actually going to present. So, for example, if there might be 10 or 15 or 20 different topics that you could fit inside your presentation, but you don't need to include those in every presentation. Your presentation may only include 3 or 4 topics. It may include bits and pieces of these topics. Remember, your goal is to close the sale and recruit the sale. That's it. Anything that you say above and beyond that is just fodder. It's just taking time. It's just making the client more and more exhausted, and they can't wait to get off the Zoom, or they can't wait, if you're in their home, they can't wait to get rid of you. Also, because your purpose of being either on a Zoom appointment or on a home appointment is to not only make the sale, but also recruit that sale, you want to show how simple and how easy and how light the presentation is. If you're giving a presentation that's 5 hours long and the client buys from you just so they can get rid of you, of course they're going to call the next day and cancel. If that's how your presentations are going, then that not only that's not good for you because the sale is going to cancel, but also it's not good for recruiting. Nobody's going to look at that and go, wow, that was pretty simple, that was pretty easy. All right. A lot of people try to give a presentation to try to make themselves look smart. Or sometimes they're so nervous they don't know how to end the presentation. They don't know how to shrink it down. So watch this presentation over and over and over again. Look at the actual presentation parts and learn from it. So the first thing I want to talk about is you're going to notice that I'm going to go back and forth between if this were a Zoom presentation or some kind of a video presentation, or if it was a home presentation, because pretty soon this Zoom thing is going to end, this Corona thing is going to end, and we're going to be doing actual presentations in homes as well as on Zoom. So keep that in mind, that if I talk about a kitchen table type of a presentation, I'm just going to build that in so that we can have a dual purpose for this video. So the first thing I want you guys to realize, all right, let me share my first screen here, is when you walk into somebody's home and you kind of do a quick chit chat. If you're talking to them, you want to get to meet them a little bit. Your goal is to try to get to the kitchen table as quickly as possible. What I used to do a lot was I used to go in their home and I used to, kind of make them feel comfortable, kind of say hello. If they had me sit at the couch, that would be fine, but that's not where you want to do your presentation. You want to ultimately get up off the couch and go to the kitchen table or the dining room table, one of those places. And don't be afraid that if they're telling you, no, it's okay, let's stay here on the couch. Don't be afraid to say, well, I appreciate that, but it's really better if we go to the kitchen table, if we go to the dining room table. A lot of times people's kitchen tables are a mess, so they're a little bit embarrassed about that. Don't feel bad by saying, don't worry about it. I'll help you clean it up, pick up the stuff, put it on the kitchen counters, and pick up a little paper towel and maybe wipe it down. Don't be afraid to do stuff like that, right? If it's their dining room table, most people never use their dining room tables, and their dining rooms are covered with little tchotchkes and little placemats and things of that nature. And so don't be afraid to move those to one side of the table. If there's a big arrangement in the middle of the dining room table, kind of move that to one end. And so you free up the one end that you're going to be using. Once you walk into the house, don't forget to have a smile on your face. When you're starting your Zoom presentation, don't forget to have a big smile on your face. The role of the trainee is very simple. The trainee is going to introduce the trainer, and pretty much for the duration, the trainee is going to stay quiet. And don't feel bad. Some trainees are more than happy to stay quiet. Some trainees want to keep showing themselves and talk about how smart they are. That's not the purpose. The purpose of this is we want to go over, we want to close a sale, and we want to recruit that sale for the trainee. That's really the purpose there. Okay, it's not a social visit, even though we're going to build in some social aspects as well. I used to always walk up to the, if they had a mantle, if they had a fireplace mantle or something like that, I would go up to it and I'd look at some of the pictures. Usually families have family pictures and trophies and awards kind of put up there. I used to ask about those, who's who, and people are very, very happy to talk about those things. And remember, your goal is to build rapport, and your goal is also to get them to like you and to trust you. That's ultimately how you're going to close any sale, and that's how ultimately you're going to recruit anybody, is if they like you, they trust you, they want to be around you, they want to follow you, and things of that nature. Okay, so when you do get in there and you ask them that you want to be seated at the kitchen table, you're going to notice on this video that the seating is kind of a little bit tricky. It's important. Sometimes the trainee, being new, they just kind of go and plop themselves down. No, they need to look at their trainer and get their cue from the trainer. As a trainer, don't be afraid to direct everyone where they need to sit. Now, if you look at this diagram, I said that's you, the trainer, okay? I'm right-handed, so I wanted to have my right hand near the client and be able to near the spouse. So that's how I always used to sit. If you're left-handed, you want to flip this where you and your trainee are sitting at the top of this diagram if you're left-handed. Also, I'm a male, so I always made sure that the male client would be sitting next to me, and then the female would be across from me. I always made it a point of that. If you're female, you probably want to reverse that, where you want to have the female next to you and the male. There's a lot of reasons to that. If you think about it, it'll all make sense. Again, these are just some guidelines. Obviously you can do what you want. The other thing is, I never would sit in the middle of the table where I have the client right now at this diagram. I would never sit there because that would make the client and the spouse sit across from each other. And that's not a good thing, because they could look at each other, they could give signals in terms of, we're not going to do this, or, whatever. You want them sitting next to each other like you see in this diagram. Now, as far as the Zoom appointment is concerned, I believe it's important to have the partners, the decision makers, sitting next to each other in front of you on one device. You want to discourage them from having two separate devices, because again, they could be in separate rooms, or they could be sitting across from each other and giving signals to each other, and that's not a good thing. You want to be able to build this emotional bubble, and you want them both seated next to each other presenting. You could present to them at the same time. Also, the trainee, you notice, is sitting next to you, the trainer, and the trainee's job again was to introduce and then stay pretty much quiet throughout the whole thing. There is one part where the trainee can come in and keep the subject going, and that's the part where the trainer needs to run some numbers and do some calculations, and the trainee should take their cue and be able to come in at that point. Other than that, the trainee is not to ask questions. This is not the time for the trainee to ask questions. This is for the clients. They can ask all the questions that they want. But when a trainer stops and says, "Do you have any questions?" the trainee is not to chime in and say, "I have a question." Trainee should hold all their questions for another time, preferably that night after the appointment is over, after everybody leaves, or after the Zoom appointment is over. Then they can get on the phone, or they can get on Zoom with each other, trainee and trainer, and the trainee can ask all the questions that they want. Okay, so that's as far as the seating is concerned. Now, let's talk about the presentation. I highly recommend that you have a PowerPoint type presentation ready. I'm going to show you our PowerPoint presentation. If you want to use this, great. If you don't want to use this, make sure yours is a PowerPoint. I believe it's important that it's a PowerPoint because it's fixed. Now, obviously, you could add things to it in terms of verbally, you can add things to it. But the reason you can also do sort of what we call Elmo, where there's a little camera sitting to the side and there's a piece of paper and you could be writing on the Elmo. You could also do that type of presentation. I believe that's a little bit less transferable because if you have a PowerPoint presentation, then you can transfer that. You can just give that to your trainee. You can give that to all your downlines in your organization. And that sort of makes it easier. Now, again, they can take that, they can learn it, and then they can add to it or take away from it. So this presentation that I'm going to give you is a PowerPoint presentation, and you don't have to use all the elements. As I said at the beginning, use what you feel you need to close the sale. This is 27 years of experience has gone into this presentation. I invented this presentation. I invented the next parts that you're going to see. So again, you could do your own, and that's fine as well. So let me show you how to start here. So you're going to, you want to have a screen open already, preferably. You want to have a browser available, and you want to have this website pulled up. Now, I haven't got it pulled up because I want you to see the steps that I use to pull up this website. If you notice, it's called Makanvand.com. And so I'm going to start by getting in there and entering it. Now, I would have done all of this ahead of time, and I'd be ready and prepared by having the screens up. Now, you're going to notice that the Makanvand website comes up. Now, this website is only for the Makanvand hierarchy. It is password driven. You didn't see it asking for a password because I had already put in the password before. We changed the password weekly as to prevent people from the outside to have access to it. This is for our internal use only. Now you're going to notice web apps. So I'm going to park my mouse on top of it, and I'm going to click it here, and it's going to take us to the next screen here. And I'll just kind of show you around a little bit. We have a financial calculator here. This is one that we found on the internet. It's just a standard financial calculator. You should learn how to use that. There's one main thing you're going to use right now, which is the TVM calculator, time value of money. You should learn how to use that and familiarize yourself with that. There's also another calculator in there called a loan calculator, and we're going to need that later on when we start to sell loans again. The box close app, you're going to notice right here. This is going to be used in another presentation. As I mentioned earlier, we're going to learn how to do the box close. There's a simplified box close. And then here we go, the Makanvand presentations. There's two presentations. There's one for securities licensed agents, and there's one for life licensed agents. If you're life licensed, the same password that gets you into this website will also get you to the presentation. If you're not life licensed, if you're life licensed, you use the life only. If you are securities licensed as well, then you're going to need you're going to need two things. You're going to need a user ID and a password to be able to get into that one. So that one is exclusively for agents that are securities licensed, and this one is for life licenses only. Now, while we're here, let me take you down further. There you're going to see some scripts. These are how to overcome some objections and things of that nature. And then we're going to do an entire video on how to get a dollar commitment, how to get a money commitment. And the verbiage is also in here, and the wording is also been posted. So you could look at that, you could study it, learn it, as well as you're going to watch the video when it's available and it's posted. All right, so we're going to go into the life-only presentation right now. And this is very simple. All you have to do is use your forward and backward arrows to navigate through this. And so here we go. I'm going to start by saying, so John and Mary, thank you so much for allowing us into your home. Or John and Mary, thank you so much for giving us this time on Zoom. On behalf of myself, on behalf of Billy is the name I'm going to use for the trainee, myself, Billy, and on behalf of the company, I want to thank you guys for the time that you're giving us. I promise you that you're going to take so much away from this time that we're going to spend together. I promise you that you're under no obligation here. We're going to share some very, very, very powerful concepts with you. And I think you guys are going to take away a lot from this presentation. Now, if you see something that you believe is going to benefit you, by all means, I want you to use it. I want you to take advantage of it for yourself. But remember, you're under no obligation. The other thing I want you to think about is, as I'm giving this presentation, I want you to think about, who do you know that could benefit from these things? Oftentimes, people will stop me and they go, "Oh, Alex, you got to talk to my brother, my cousin, my coworker, my best friend. They could really, really benefit from these things." So I want you to kind of keep a mental note from that. Now, before we get started, John and Mary, do me a favor. Tell me, do you guys have any questions at all about anything? Wait for the answer. They're going to say yes. They're going to say no. Most likely, they're going to say, "We don't have any questions. We don't even know what you're going to talk about." And that's how it should be. If they do have questions, make sure you address them. You don't want to get into a presentation with this big cloud hanging over your head, and they have these questions that they want to get out, and they were, maybe they had heard something negative about you, about your company, about products, maybe, all of that. They might say something like, "You know what, we're not going to buy anything today." And your answer is, oh, absolutely. Don't worry about that. Remember, I told you, you're under no obligation. I mean, the absolute last thing I'm going to ask you to do is to buy something. And but if you do see something that you believe is in your best interest, you can go ahead and take advantage of it. Is that fair? They'll say, "Yeah, that's fair." So great. All right, let's get started. So we're going to talk about some very powerful concepts today. We're going to talk about three things today. We're going to talk about, as you can see, number one is saving and investing money for the future. Number two is getting out of debt. And number three is protecting your family and protecting your assets. As you can see, John and Mary, these are some very, very basic concepts. These are some very, old-fashioned. These concepts have been around, since the beginning of time. And we feel that most American families, most families just don't have the time, the inclination, to sit down and look at these things. And so let's talk about our first subject today, which is saving money. Now, let me ask you guys something, John. Do you guys feel saving money is important? Yes, we do believe it's important. It's very important. All right, great. Are you guys saving any money? Yes, we are. We have a plan through our job. We don't have a plan. We're saving in the bank, so on and so forth. All right. So where do most people save their money? They either in bank accounts. Now, what kind of interest rate do banks pay? Last time I looked, is like 0.1%. Sometimes maybe a whole percent, right? Well, let's be nice and let's say that banks are actually paying 2% now. They're not, but let's say they are. Now I'm going to ask you kind of a question, silly question. Let's say you had $1,000 and your goal was to double that money. So John and Mary, you take your $1,000, you stick it in a savings account in a bank where they are paying you 2%. I want you to take a wild guess as to how long do you think it's going to take for your money to double. So the key word, the operating word here is double. All right. So John, how long do you think it would take? He'll say 10 years, 15 years. Mary, how about yourself? How long do you think this will take? 10 years, 15 years. Whatever answer they give, I always used to say, you know what? Great answer. That's the number one answer. That's the number two answer. Now, another thing you notice is I'm going to ask John, and I'm going to ask Mary. And then I'm not going to just ask and move on. I'm going to ask and I'm going to pause, make sure they give me an answer. Okay, never focus on a single one of your clients. Make sure they're both being engaged and they're both being involved. A big mistake that a lot of men make is they focus all of their talk and all of their attention to the male, and maybe females do the same thing. They focus more on the female. I don't know, because I'm is a male, right? So make sure that you're involving both of them. Make sure you don't ignore one. I heard stories over the years how the wife, I would go to somebody's home and the wife would say, "Yeah, somebody came and gave us a presentation from another company, and all they did was they talked to my husband, and I kind of felt left out." So don't make those kinds of mistakes. Make sure you're talking to both. Also, if you're using a Zoom type presentation, make sure you're looking into the camera as much as possible, because that gives you eye contact. If you're in person, make sure that you're stopping and you're talking to them. Now, I'm a kind of a touchy-feely guy, and one reason I always want to make sure that the male counterpart was next to me was that if I do reach out and I touch his arm or his elbow or something like that, that I don't come across as in an unpleasant way. and maybe most people don't care about that stuff, but in case they do, I wanted to make sure that I don't come across in a bad way. So, all right. So, John, how long do you think? 10 years. Mary, how long do you think? 15 years. You know what? It's funny. Those are the number one and number two answers that I've gotten over the years. And you guys are pretty close to what other people say. But let me tell you how long that would take. It would literally take 36 years. All right. I'm going to show you how we figure that. Okay. There's a formula that we call the rule of 72. And Ben Franklin actually kind of came up with this formula years ago. There were no computers or calculators. There were maybe slide rules back in the day, but he kind of figured a quick and dirty method. He figured out that if you divide the number 72, and it works with 72, if you take that and you divide it by your interest rate, the answer will be your doubling period in years. So, for example, let's look at the example of the 2%. If you take 72 divided by 2, so I'm going to go back. So this is part of my presentation. So John and Mary, at 2%, if you take 72 divided by 2, what are you going to get? You're going to get 36, right? So that's how I came up with the 36 years. Now watch, it works with other interest rates as well. If you're getting 6% on your money, you take 72 divided by 6, and now you're going to see that your money doubles every 12 years. And if you're getting 12% on your money, okay, it'll be 6 years. Now I'm going to ask you my first of many dumb questions. I'm famous for my kind of stupid questions, but I'm going to ask you my first one. Which of these years would you rather wait? Would you rather wait 6 years or 36 years? How many? Of course, 6 years, right? I mean, that's pretty much a no-brainer. All right, great. Now let's take this to another step. This whole concept of rule of 72. I'm going to take it to a whole new level. Let's say that the left side, that's today, and the right side, that's 36 years from now. And let's say that today, you and I are both sitting here with $10,000 in our hands. So that's me on top, and that's you guys on the bottom. And we each have $10,000 in our hands. Now I'm going to take my $10,000 and I'm going to put it in the 2% account. See that 2%? And now how much am I going to have 36 years from now, right? If you go back and look at the rule of 72, according to the rule of 72, at 2%, it takes 36 years to double your money. Remember that? So my 10,000 is going to be $20,000. Exactly. Now you guys, you on the other hand, you found somewhere where you're earning 12% on your money. All right. Now, how long will it take you, or how much money will you have at 12%, 36 years from now? Well, let's take a look. At 12%, if you go back to the rule of 72 again, you're going to notice that your doubling period is now 6 years. Every 6 years, your money's going to double. And so the first thing I'm going to do is I'm going to take that 36 years, I'm going to break it up into 6 equal parts, which is 6 times 6 equals 36, right? So we're going to have 6 periods of 6 years, or 6 doubling periods in the same 36 years. So watch what's going to happen. Your money in the first 6 years is going to do what? It's going to double, right? Rule of 72, money doubles every 6 years at 12%. So now you already have 20,000. So you have the same money that I had after 36 years. You have the same money now within 6 years. Now look at the next 6 years. Your money is going to double again into 40,000. Next 6 years, double again into 80,000. Then you notice it's going to be double again, 160,000, double again, 320,000, and double again into $640,000. Now again, stupid question. Which one would you rather have, John and Mary? 20,000 or $640,000 after this period of time? The answer is obvious, $640,000, right? So, but how's that possible? Didn't we both start with the same amount of money? Didn't we both wait the same exact period of time? So we both were patient, we were both savers, we both started with the same ability and the same wherewithal. But that difference, is that a little difference or a big difference? It's a huge difference, right? How is that possible? That's the magic of compound interest. You know, everybody that's ever purchased a mortgage or anybody that's ever had to pay interest knew that the slightest amount of change in the interest rate that they were paying would make a huge difference over a period of time. Well, guess what? The same concept applies if you're earning interest. It's the same exact thing, isn't it? Don't you find that interesting? So, banks, what do they pay? They pay 1%, 1.5%, 0.5%, 0.1%. And what do they do with that money that we give them and they give us like nothing? They take that money and they do one of two things usually. They invest that money or they lend that money. And with the same money that they're giving us virtually nothing on, they're earning. So you're seeing the difference between what the bank earns on your money and what you're earning on your money. So what we're suggesting is, listen, get rid of the middleman. Let's go directly to where they go. Now, obviously, we're not in the lending business, right? But we certainly can put our money somewhere where we can make more money. Now, let me stop here. If you're securities licensed, you can go to the next segment, which I'm not going to cover right now, and talk about where we invest our clients' monies. We use mutual funds and some other vehicles like that. If you're not securities licensed, you cannot go any further. You can say that you can say, John and Mary, I have on with me Zoom, or I'm going to bring on to Zoom with me our investment guru and our investment specialist, and he or she, they can cover that part for you and show you where we can go to earn higher rates of return. Okay, so all right, so any questions about the first part, saving money? Great. All right, so now let's go to our second part, which is eliminating debt. Now, I'm not going to spend a lot of time on this, but I'm just going to tell you this. Our job is to help you guys, John and Mary, to live a debt-free life. What we have found out is that most families are spending the majority of their earnings and their income servicing debt. And the reason that they don't have a lot of money, that they don't get to amass a fortune, is because their money goes towards paying interest rates rather than towards going for their own financial future. So we're going to put you into programs that are completely free of charge and are able, we can help you achieve complete debt-free status within a very short period of time. Isn't that interesting? So in order to get out of debt, you've got to have a plan. You got to learn to pay yourself first. That's what I was talking about in terms of paying all that money towards debt versus putting all that money towards paying yourself and your family. And you got to learn how to monitor your credit, right? So we're going to put you in what we call debt stacking or snowballing, and we're going to use an incredible tool called a financial needs analysis that will assist you and help you. And we offer this financial needs analysis completely free of charge. Other companies charge anywhere from $500 to $1,000 for it. We do it absolutely free. And by the way, in case you were wondering how we get paid, you don't have to pay us a dime on any of the products that we offer. We get paid by the companies that we represent. So you don't have to worry about, oh, what is this going to cost me? How much is this going to cost me? Basically, we give you all this advice for free and all this education for free. Isn't that amazing? Pretty good, right? So let's go to the third part. And the third part is what we call protection. Why don't we get right into that? So the whole concept of protection is to protect your assets, to protect things that you own, to protect yourself legally, to protect your home against burglary. And so we have all these different types of protecting yourself. We're going to focus right now on protecting your family. So follow with me on this diagram. Let's say that I'm going to draw you a basic picture of a family. You've got the mom and the dad, and you've got a couple of crumb crunchers and some pets in the family. And let's say that they own a couple of cars, or let's say they're making payments on a couple of cars. That's more like it. And they own a home, or again, they don't own the home. They are making payments on the home. And that's your typical family. And let's say that this couple is making $30,000 a year each. So that's a total of $60,000 a year. And let's say that their expenses and taxes and all that are about $50,000. So this family is really on a $10,000 surplus because they're very careful and they're very prudent and they're very frugal, and they still have a little bit of a surplus, so they're able to put a little money aside for their future. Well, what if one of the breadwinners of the family goes from in this position into this position? So all of a sudden, that's very sad, obviously, but one of the incomes, one of the paychecks has now been removed. And so that $60,000 a year income has now become $30,000. Now, just because one of the breadwinners passes away, God forbid, it doesn't mean that the bills go away. The bills are all still there. So the budget of $50,000 is still there. So now this family is running at a $20,000 deficit. They don't even have enough money. So let's take a look at what's going to happen to them. their home, most likely, it's going to be gone. Their cars, because they don't really own anything, they have car payments, they're going to be gone. But more important than all the material things in the world that they have, what about their goals, their dreams? Healthcare, college for the kids. All those things are just gone, gone, gone. So for that reason, we are so adamant, and we're so careful to make sure that our clients are educated, to make sure that they have not only protection, but they have the right kind of protection. So that if, God forbid, one or both of the breadwinners of the family goes away, the family can continue and they can survive. Now, I don't know, John and Mary, if you guys have coverage through jobs, but sometimes clients tell me, well, you know what, I have protection through work. And what they don't know, what they don't realize, is that the coverage through work is not worth the piece of paper that it's written on. Okay, let me stop here. Time out. You noticed how I did that. You noticed how I was talking about coverage, I was talking about insurance. I went right into coverage from work. And I asked them, I said, I'm not sure if you've got any, but most people that have it, they don't understand that it's not worth the piece of paper that it's written on. You notice how I did that. The reason I did that very quickly, and I didn't ask them, do you have coverage from work, and wait for an answer and then all that, is because once you ask the client if they have coverage through work, and they say, yes, I do, and they say it proudly, because they say, I have it, I have a lot of it, and it's dirt cheap, right? Once they do that, you're allowing them to hold a position, or gain a position that now it's hard for them to get off of that position. So once the client says, yes, I have it, very proudly, and now you start to break it down, you start to explain to them how it's not worth the piece of paper that it's written on, it's kind of too late, and you're kind of hurting the client's ego, possibly, by telling them the thing that they were counting on, the thing that they were so proud of, is really no good. So you make sure that you cover this, and you say all the negative things you're going to say before the client gets a chance to tell you. That's why you don't pause at all between talking about life insurance, talking about all the things that I did on the previous screen, and then you come to the screen and you bring up coverage from work or group, any kind of a group insurance, and then you go right into saying the negative things that you want to say about it. Okay, so just to recap, so John and Mary, for this reason, we want to make sure that our clients have protection. They have the life insurance, and they have the right kind of life insurance. So for example, a lot of people have coverage through their jobs nowadays, and what they don't realize is that coverage to work is not worth the piece of paper that it's written on. What do I mean by that? So for example, a lot of these coverages from work are for accidental death only, or they only cover work-related type of deaths, and they don't cover illnesses, and they don't cover an accident that took place outside of work or something of that nature. And so they're very, very limited in their scope, and you got to always remember, why is something so inexpensive? Why is something dirt cheap? Chances are it's inexpensive because it doesn't have to pay out. For example, you can purchase travel insurance automatically by purchasing an airline ticket, or a bus ticket, or a train ticket using your credit card. Most credit cards now offer immediate and instant life insurance coverage for that trip. And so the reason it's included, and the reason it's dirt cheap, or in this case, it appears to be free, it's nothing is free, but it's free-ish, is because they rarely pay out. There's so many caveats and so many restrictions, and you don't want a coverage like that. You don't want a coverage that depends on the employer. You don't want a coverage that depends on the government. Remember, if the employer pays, offers life insurance as a benefit, they can also take it away. So what the employer giveth, the employer can take it away. I'll never forget, I had a client that worked for Disney, and Disney's a great company, and they're very reputable. And the client told me this themselves. They said, we had life insurance, $300,000 or $400,000 of life insurance on Friday when we left for the weekend, and then on Monday when we came back, there was a memo posted that they had taken away that life insurance. Now, this is back in the day, and I don't know if they have it now. I don't know if they've added it back in, but it's a benefit. It's something that the company can give and the company can take away. Okay, you never want to be at the mercy of the employer. You never want to be at the mercy of the government, not for things that are this critical and this important. Let me ask you a question, John and Mary. Do you want your family's financial future in the hands of an employer or in hands of a government, right? Let's not go there, right? You know what I'm talking about. So anyway, so we recommend the right kind of insurance. Now, there's 5 major mistakes that people make. They buy the wrong kind of life insurance. We kind of covered that a little bit. They use life insurance as an investment. If you listen to any financial expert, any financial guru, they tell you never, never, never use life insurance as an investment. And I'm here to tell you that if you deal with most insurance agents from almost any company, they're going to try to get you to purchase a life insurance policy that has insurance and investments built in. And of course, they're not going to tell you about all the traps and about all the pitfalls and all of that, okay? What we educate people on and our clients on is that, yes, life insurance is critically important. Saving money is critically important. Investing money is important, but never, ever, ever combine the two. Can you imagine sending extra money every month to your car insurance company, auto insurance company, or homeowners insurance company, or health insurance company, and say, I know I owe you $200 a month for car insurance, but here's another $200 a month. I mean, just the thought of that makes me cringe, right? Can you imagine doing that? I could not imagine, right? So, but there's technical reasons and there's mathematical reasons why you never want to purchase a life insurance policy that has savings and investments built in it. Things like universal life policy and whole life policy and things like that. Another mistake people make is they're extremely underinsured. We always recommend to purchase about 10 times your annual salary. So if you make $50,000 a year, you should purchase at least $500,000. And if you combine make $100,000 a year, then you should combined have $1 million of coverage, which nowadays is really not that expensive at all, using the type of insurance that we use. Let's see, people really don't, they undervalue, they underestimate the value of insurance. People will spend money on all kinds of things, but they don't spend money on the one thing. I remember when we were kind of poor, my wife and I, we were kind of struggling financially. I remember, she used to pay the bills every month, and I used to tell her, honey, make sure the first bill that you pay is the life insurance bill. And she used to go, why? Well, what are you planning on doing? And I always said, don't worry, hopefully nothing bad is going to happen. But if I leave here today and I don't come back home tonight, I mean, you guys are going to be devastated. This family is going to be totally financially devastated. And so, and she understood it, and we both understood the importance and the value of life insurance. So, and people will cancel the life insurance as soon as things get a little bit tough sometimes. That's not a smart thing to do. They'll pay their phone bill and their cable bill and their internet bill and their light bill and this and sometimes people look at life insurance as sort of a luxury, as the last thing. While, as I said before, it should be the first bill. I told my wife, I don't care if we sit in the dark, if we don't have electricity, but I want to make sure that if something happens, that you and the kids are always taken care of. Sometimes people make the mistake of waiting too long. They go, well, I'm okay right now. I'm healthy right now. What life insurance is for unhealthy people? That's not true. As a matter of fact, insurance companies are not going to touch a person that's unhealthy. They're not going to insure unhealthy people. You have to get in, while you're still healthy and while you're young. So the premiums are dirt cheap, right? It makes sense to do that. And later on, when we get older, if we develop some kind of an illness or maybe a high blood pressure or high cholesterol, either our premiums are going to be skyrocket high or we're not even insurable. So we have to be very, very careful. I'd rather get life insurance, 5 years too early, right, than 5 seconds too late. Kind of always think about that. So you got to make sure that you're healthy, that you qualify, and things of that nature. So now let me ask you guys, do you have any kind of a life insurance product that you own outside of the employer and outside the government? Okay, now if they do, you ask them to go get their life insurance policy, and then you go into the next presentation, what we call the Plan A, Plan B presentation, which there's going to be a separate video for that. If not, then you go into the next phase of getting a money commitment and then doing the box close. Okay, so John and Mary, do you guys have any questions for me at this point? Yes, no, make sure you answer all their questions. All right, great. So John and Mary, I have a question for you guys. So thanks for asking those questions. Those are great questions. By the way, a quick note, if they ask no questions, that's not a good thing. Okay, don't think to yourself, oh, this is going really well. I'm so excited No questions. That is not a good thing. Now, sometimes you're going to get a client that just keeps asking question after question after question after question after question, or they interrupt a lot while you're doing your presentation. I mean, you got to kind of work with that. You got to do the best you can with that. But sometimes I would say, look, guys, if I saw that there's just too many questions, I'd go, or if I knew I was going to cover those questions anyways, I go, I really appreciate your questions. These are fantastic questions. Do me a huge favor. Let me kind of finish, and then we'll see it, because I'm going to answer a lot of these questions throughout my presentation. I rarely had to do that. Sometimes, they ask a few questions, but I do want to make sure that I stop periodically and I ask them any questions, because unless they ask questions and unless they tell you what they're thinking, you're not going to know which direction to go, what's good, what's bad, if this is working, if this is not working. A lot of times people are talking through their nervousness, and they don't just stop and just kind of take the client's temperature, right? I always thought about, I thought of it like this. I was baking a turkey or cooking a turkey in the oven, and I wanted to stop and I wanted to stick a thermometer and check to see how it's going, how it's progressing. If it's undercooked, if it's overcooked, if I need to add a little something, take away a little something. And that's the only way you're going to know that is through questions, right? So after they asked their question, I said, great, now I have a question for you guys. Of these three areas that we talked about, saving money for the future, living a debt-free life, and protecting your family, which of these areas do you think is the most important? And they tell you, I think getting out of debt is important. I think saving money is important. I think life insurance is important. Great. And this is part of your people skills. Whatever they say, you agree with. You say, you know what, you're right. That is absolutely important. Mary, what do you think? John, what do you think? Absolutely. Getting out of debt, I think that's absolutely important. Saving money, I think that's absolutely important. Don't show any preference to one or the other. Don't get super excited if they give you the right answer. There is no right answer. There is no wrong answer. Their answer is their answer. As a matter of fact, based on the answer, which area you need to talk about more or less, or shore up, and all that stuff. So, John and Mary, which one do you think is important? They'll give you their answer. You'll agree with them. Well, let me show you a concept here. Basically, of these three areas of saving money, getting out of debt, and protecting your family, we believe all are important. Don't you think so? I mean, I think you kind of said the same thing. They're all important. Let me show you this. Let me explain why. I want you to think about, assume that I'm not just a financial guy, that I'm a general contractor. And let's assume that I'm going to build you not a financial house, but a regular house. Well, in a regular house, you have your three parts. You got the foundation, you got the structure, and you got the roof. Now, if I were to ask you, which of these three, John and Mary, do you think is the most important in a building, in a structure? What would you say? Exactly, foundation, right? Most people have always answered that. To me, they always say foundation. No one's ever gotten this wrong. Well, now, what if I was not just your regular contractor, but your financial contractor? Okay, I would still want to build you a financial house, and the financial house also has three parts. Now, the roof of your financial house, that's equivalent to the first part, saving money, because the only way you're going to have a roof over your head, the only way you're going to be able to stop working and stop worrying about money is if you save money for the future. Does that make sense? The structure of your financial house, that's like getting out of debt. That's the second thing that we talked about, because we kind of see debt as termites, eating away at the wood structure. It kind of is equivalent to that. If you're debt free, you have a strong structure. If you have debt, you're constantly spending all your money servicing debt. It's a weak structure. It feels like the whole house is going to come crashing down. And the foundation of your financial house, John and Mary, that's the protection, because it's instantaneous. As soon as you invest in life insurance and you get some life insurance, that's like pouring in the foundation of the house. You're protected. It's instantaneous. Right away, you have peace of mind. The other two, the saving money and the getting out of debt, that's like building the house one brick at a time. That's like putting a roof on one tile at a time. So those things take time, while your foundation is instantaneous. You put it in, it's done, and you feel safe, and then you build on. So I suppose what I'm saying is, in our world, in the financial contractor world, if you will, the life insurance part, even though they're all important, all three things are important, the life insurance part is the most important. As I said before, you put it in, you build it, you're done, and you go on with it. Does that make sense? Great. Now, you guys have any further questions for me? Yes, no, great. All right. So this concludes our presentation part of our videos. I hope this helps. Give your RVP a call if you have any questions. Give myself a call if you have any questions. And we appreciate you, and we'll talk to you very soon.